Urvashi, welcome to Between Two Quarters. I'm really excited to talk to you today because you have this amazing perspective on how large companies buy software. Your background fills that all in. So you've been building B2B software for 20 years across a range of industries, financial services, healthcare, among others. And you've been the CTO of not one, but two S&P 500 companies, which is really impressive. So we're just going to jump right in. And I'd love to start by getting your perspective on what's changed in buying enterprise software for large companies over the past few years.
Thank you, Dan. First of all, I'm so excited to be having this conversation with you. I have to say, if you look between and today, the whole software buying process for these Fortune 1000 companies has evolved across three big phases. And these phases also kind of reflect their maturity from a digital transformation standpoint. And so you can think of this first group of companies as more like traditional digital companies.
Mm-hmm.
There are these pre-cloud adoption. You will find less than 25% of the workloads are in the cloud. And a lot of these companies, they buy software for deployment on-prem.
Mm-hmm.
So what's really important for these companies is that the software provider has a really strong on-prem system for their deployments. They're also looking for it's a bundle servicing.
Yeah.
So they want the software plus they want the services and the integration support. And they are looking for fixed pricing. And so you remember a couple years back.
And by fixed pricing, you mean just like annual contracts?
Yeah, just annual contract pricing. That's just how they manage their budgets. I remember like a couple years back, we were evaluating a product and really awesome product, top tier tool, but we had to pass it because they didn't support on-prem architecture.
Yes.
But then companies have evolved and they entered this next phase, and you could call this like the post-cloud adoption phase, and you could call them also digitally transformed companies. These companies, what they are looking for is a SaaS-based offering.
Mm-hmm.
They're looking for flexible pricing, if preferable, a usage-based pricing.
Yes.
And so it's like this whole premium model and the premium model, the whole modular structure around the cost, etc. And I think it's also a great place for the software providers to have this land and expand strategy. So a couple years back, we did our analytics software deployment, a SaaS-based offering. We deployed it for one region. And then we captured user metrics for 2 quarters. And then in less than a year, we had deployed that product across the enterprise. So you land in one place, but then you earn the trust, you have a great product, you demonstrate great leadership and great user satisfaction, and then you can
end the product.
So that's your second phase of the company. Yeah. And then you enter this next phase, which we see actually it's really emerging now, and you could call them as the digital pioneering companies.
Yes.
Like your AI era companies. And what they are looking for is really an AI native product. And the most important thing for them is, for these companies, is that you can demonstrate transparency of your Gen AI offering. They want to understand how the data will be used, how it will be protected.
Yes.
And then they're also looking for ROI-based pricing. You have to demonstrate that. And these are the companies that they don't have new budgets for Gen AI products. And so you have to also demonstrate that not only it's an ROI-based offering, but then which legacy product you're going to replace.
Got it.
And so it's really important for the software providers to understand the company's state of digital maturity and then accordingly align their selling approach to the companies.
That's really interesting. One thing you told me when we spoke before was about the development of, let's call it an investment council or investment committee that's centralized and could use all potential third-party software purchases. Talk about how that's developed and changed the buying process over the years.
You know, that has actually evolved in many companies that have moved from this pre-cloud to post-cloud model. And you can think of this post-cloud model is where there's more centralization of the decision making. So when I was at ADP, we were leading this transformation. And what we did there was we had a CIO, we formed this CIO-led software council. And this group had representation from procurement team, the finance team, SMEs from across the organization for different areas of tooling. So for example, there could be an SME for developer tools, for marketing products, finance products, and all of these people are represented on the software council. So any new software contract renewal that happens or new software product that needs to be bought, the decision will be made by the council.
Gotcha.
So you can see the company may have multiple BUs, the company could have multiple P&Ls, but once the company gets to this stage where it's more mature digitally, they form this kind of centralized cross-functional teams, but the decision making for software procurement becomes centralized.
Very interesting. And we're going to get into a little bit of personas on the buyer side further in the chat. But one thing I wanted to dig into is as we think about Gen AI and all the progress around Gen AI, does that change how companies are buying software, or will it change how companies are buying software over time?
I think it has started to change, and we see kind of that evolution across two main fronts. One we see is around trust and responsible AI. And so it's out of the box when you're pitching your Gen AI based product to a company, which is actually also fairly a digital maturity. And that's why they're having a conversation with this software vendor. One thing they are looking for is, again, the understanding of how their data is used, how their data will be saved, how it will be protected. They're also looking for architectural level transparency.
Yes.
They want to see documentation on model behavior.
Yes.
What will be the risk? What are the mitigations? I remember we were evaluating one team, and they did a fabulous job in educating us across all the layers of their Gen AI stack. So we were able to understand how our data will be used, how models are getting trained, what is the output from these models, how is that output from the models used for decision making in the product and used in the user experience. So we had all of that understanding, and so transparency has become a very key part, an expectation out of the box that you will offer that. And so it's like, you could call it like no trust, no deal. That's the first thing.
I love that, because you really are relying on these third-party vendors to produce outcomes, versus in the old world of sort of buying SaaS software, it was sort of an empty repository for data, right? And it wasn't responsible for an outcome. You were responsible for the outcome as the enterprise buyer. At MVP Capital, we're doing a lot of vertical AI investing. So one thing that I wanted to sort of dig into with you is, how do you think about large companies partnering directly with the model providers, like OpenAIs of the world, and kind of building their own suite of products on top of the foundational model, versus going out and finding a third party that's kind of built a vertical AI solution?
I think what we will see is, of course, a lot of these Fortune 1000 companies, they don't want to start creating this proliferation of internal tools themselves. There's always going to be a preference to buy. At the same time, they will be doing a lot of experimentations of their own, because they're also educating themselves and their own organization. But any of the third-party software providers that comes in and offers them what I was mentioning earlier, the trust, that transparency. And secondly, if they offer them this business value over features. The business impact is a very high priority for these companies to make this investment. And keep in mind, they don't have additional funds for it. And so when you come in and show that business impact, you're going to show cost savings for them, productivity gains, faster insights. You cover through these multiple angles. And that's what these companies are going to look for. And if there is a software provider coming in, offers these two things, the trust, the security, the transparency, shows them the business value, these companies are not going to build on their own, because it's clear they're not in the business of building these tools. They have their own business to handle. But at the same time, driving internal efficiency and this ROI internally is really important for them. And so if they don't find the right providers, they will build in the meantime, but they will be more on the buy side if there are those providers available, and they'll partner with them.
That's really interesting. I like how you phrase that, which is like the budget doesn't necessarily exist. You almost have to create the budget by showing ROI.
Then show which legacy tool will you replace, or which set of legacy workflows will disappear.
That's great. Now, maybe let's get a little bit more into the weeds on how founders or how startups should think about selling to large enterprises. Can you talk us through maybe the personas of different buyers in the enterprises you've worked with?
So one of the ways to look at this is, for any of these software provider companies, they first need to understand, as I was discussing earlier, that what stage of digital maturity these companies are in. And then there are all these players in the company that will be involved in the decision-making process. It's really important to understand there are these 4 personas, but these personas could play a different role based on the digital maturity of the company. And the 4 personas are, you have the decision maker, you have the budget holder, end user who will use the product, and you have the procurement lead. And so if you're working with these traditional companies, like the pre-cloud companies, the decision maker in many cases is really the either the financial functional head, like your CFO or your CPO, or it could be the business unit leader. The budget holder could be the CIO or it could be the business unit leader. If it's a CIO, they're just acting as a bank. If there's money in the bank, they'll give you. If there's no money, you can't buy.
As long as the business leader makes the case.
As long as the business leader makes the case. In the end users, in this traditional companies, they're minimally involved. They might be involved a little bit, but they don't really have a big say. It's the executive who's making the call. So you're really selling to the executive. And the procurement lead may be involved later in the stage for terms negotiation and the financial negotiations. And so this is a very common model. You'll see in these companies a lot of product sprawl. You'll also see for the same software vendor, there could be multiple independent contracts in the company.
Yeah, I've heard that.
Because they went to sell to these different groups because they're different P&Ls and different budgets, and they all made their deals independently.
That's right.
And the procurement team was centralized, but they just executed on what the BU leaders wanted.
Yeah.
So it's very common. I've seen that.
I think some companies that are third-party software companies live in fear that a big company is going to get together and say, wait a second, we have like 30 different contracts. We're spending $1 million a year. We didn't even know it.
And that has happened already. I saw that happening, and part of my coming into some of the organizations was also driving this transformation. And so you come to this next stage companies, which are the post-cloud companies or the digitally transformed companies. In these companies, your decision maker could be the CIO, and it could be the SME for the particular product that you may be buying. They may be jointly working on the decision. Your budget holder could be the CIO, but also now the CIO is not just the bank. The CIO could also question, why are we considering this other tool when we have 5 other similar tools in the company? Your end users are involved. Their feedback is taken and it has weight in the decision making. Your procurement team could be involved more early. They may be facilitating a lot of this process.
Interesting.
And so in these teams, you'll find, example I was giving of software council, that falls in this category. And these people work together in a more centralized model, and they may consolidate these contracts, renegotiate these contracts, and you'll start to see a much simpler stack of third-party products in the company. But then you head into this next group, which is your digital pioneer companies or your AI era companies. And what you'll see here, decision maker is the CIO, the CTO, and your SMEs. They will make either executives may be involved, but they are not going to be the decision maker. Because again, you're looking at the technical architecture of the system. So your CIO and your CTO will be involved. And these are very user-led decisions. And so the user will have a very high weight in the decision-making process. Your budget holder will most likely be the CIO. But again, keep in mind, no new budget. It's replacing existing budget. Your users are highly involved. Your procurement lead will be actually involved in risk analysis, ROI assessments. So they are not just facilitating the process, they're deeply involved in driving the process into the end game. And so it's really like for these software providers, not just understand the stage of maturity of the company, but understand how the roles of this different persona evolves once you've understood what state of maturity that this company is in. Because you really want to bring all this together if you want your deals to close faster.
On that front, if you were a startup selling into a Fortune 1000 company, how would you change your go-to-market based on those different personas or of companies?
So your go-to-market, it's like there's a number of due diligence work that needs to be done in advance here. Early on, even before you do your first meeting with the company, you want to understand how many P&Ls. Is this a company, multi-P&L company? Because of course that could mean silos of budgets and decentralization. You want to understand, does this company have a CIO who reports to the CEO? Because if that is the case, then the company has more governance and there's tighter control and more centralization. Other ways to look at it is once you get into your first set of meetings, it's really important to not be really a pitch meeting, but just informal introductory meetings through maybe some ex-employees who have now retired, become advisors. You reach out and just try to understand as much as possible about the organization. And I think asking questions in your first meeting with the company, whoever you are meeting with, is all fair game. Asking the right questions around who's going to approve the budget. Is it the CIO? Is it the business unit leader? Is this a new budget or a replacement budget? Who else needs to weigh in? Because you are trying to understand those hidden gatekeepers in the company. Is 100%. It the legal companies, AI governance in the loop? What will be the role of the CISO, the security team, etc.? You also want to understand where are your users in the company? Are they spread around business units, or they're in a centralized organization? Because it will give you insights into the adoption structures in the company. And I think understanding all of this, it's like decoding the decision dynamics of the company
100%,
is really important. I have sat through a number of sessions around this where I know these people were not talking to the right people, and some of these decisions could derail for the company internally. Because if you're pitching a product to me and I'm one of the SME, I don't know how to work with my procurement team. A lot of time SMEs don't know the procurement teams. SMEs don't want to work with security and legal because they will leave it to you, because you have to eventually drive this.
Right.
So as a software vendor, you're not only selling your product, your leadership, earning the trust, your product roadmap, but you're also making it simpler for the decision to happen within the company.
That's a very interesting perspective. It's like you, as the seller, you have to own as much of the process as possible and take friction away from maybe the business buyer, right?
Absolutely.
What mistakes do startups specifically make in selling to large enterprises? What are some repeat mistakes that you see?
I think the biggest mistake I see is companies thinking that the selling process starts at the pitch. It actually starts at product design. Because if you are building a product without understanding how it fits into the user journey, then what you're really doing is you're selling a point solution. And when you're selling a point solution, it's not grounded in how work gets done within the enterprise. And so one of the ways to look at this is, when you are designing your product, understand how this product fits into that user journey, what other products surround your product, how do you partner or integrate with these other products, so that when you are selling it, there's a seamless adoption of your product. So I would say this is one of the biggest things that I've seen, because the companies are not looking for another disjointed product, at least not anymore.
That's really interesting.
The second thing that I've seen in general companies work through is the founders, they're not running their own product. When I meet founders, I ask them, do you use your own product? And less than 20% of the time I'll hear a yes. It could be maybe a little bit, yes, it's on our to-do list. And I was at Microsoft and we called it dogfooding. And dogfooding wasn't an action. It was like a culture. You live your product. And
yes.
I definitely want to see more founders living their product. And the third thing I would say, the third mistake I see is underestimating the power of references. Very rarely I see strong references coming to me for the product at the pitch stage. And some of these companies would say, we are so early, we don't have very strong references because it's just getting started. But really, if you're part of a VC firm, then start selling to your portfolio companies. If they are the market, sell it to them. Be yourself, be the user, and use your portfolio companies, use your own deployments as references. Because really the fastest way to get through this is, one, make sure your product has a place that gives you inside access to how enterprise do their work. And so it's part of the journey. And then you back that up with references.
So references, is that something that you're selling into? You're talking to the decision maker. Should you just be proactively offering references? Should you be having other customers inbound the person you're selling to? How active should startups be with using references?
Yeah, you could have your deployment use cases as part of the pitch. You could add them to the appendix. Show as many examples of your deployments, real deployments. And I think once the companies get a little bit bigger, you start publishing case studies. You work with your customers and start doing that early. You want that early flywheel of references rolling in.
I love that. I'm going to repeat that in my next board meeting. Whoever it is going to get that advice, because it's great advice. More references earlier in the process. Let's talk a little bit about innovation groups, because a lot of big companies do have innovation groups, and their remit is to find and introduce startups into the ecosystem. Is that a good use of time for startups, or is that like a time waster? How do you think of that?
So innovation groups are a good, I would say, entry point in the company, but I would say don't mistake that for traction. And here's why I say that. Right, most of these innovation groups in the companies, they don't have their budget for in-house engineering team, but they are tasked with doing these pilots and experiments for the company. So they have to depend on third-party software to do this. So if their pilot succeeds, they don't own the budget, they don't own the roadmap, they don't own the scaling decision.
Right.
But if the pilot is scrapped, then your product goes with it, right? So I think one of the ways to look at that is consider them as a good way that opens your door to a company gets to know you, but then also make sure that your product can be tied to real business need. Otherwise, that pilot would be the end of your access to that companies.
Got it. So the pilot shouldn't show up on the sales pipeline as like a long-term contract.
It's pipeline.
It's just, it's
not
not
from
sales,
the innovation
it
teams.
shouldn't be on the sales pipeline. I love that. Let's take it off the sales pipeline.
Yes.
It's a whole other thing. All right, great. That's great advice. The really final question that I want to dig into a little bit is, how do you think about pricing for software companies that are selling into large enterprises? How should they think about pricing? Is it a core consideration? Maybe get into that a little bit.
So I think pricing is important. I look at in terms of the overall considerations or the core considerations.
Yeah.
There are like 3 legs of a stool to make that final decision for a enterprise customer. Pricing is one of the leg of the stool, but the 2 others, one is the trust, the security, the transparency. That's table stakes. The second is the user adoption, utilization, and satisfaction metrics. And if your users won't love the product, it won't stick. But then, of course, the third leg of the stool is pricing. And as we were discussing some of these 3 different phases of the company's digital maturity, the pricing has to match that. So for example, if you are selling to a traditional company, the pre-cloud company, you want fixed pricing, you want servicing bundled in your pricing, they're not looking for an additional contract for servicing. And so you want to align there with their expectation of where that company is. If you're selling to this post-cloud organization, more of the digitally transformed companies, they're looking for the SaaS model. They don't want to pay a lot of money of fixed cost upfront.
Yes.
They, in most cases, they want a freemium product and then they want premium. Or they want, if you give them fixed licenses, they are looking for tiered sets of licenses, and the cost vary per those tiers, right? And so you have to align with that. And getting to value is really important to them. But then you head into this last group of companies, the AI era companies, the digital pioneers. They absolutely want ROI-based, complete usage-based pricing, ROI-based. Show me what cost you will save.
Yes.
By default, if you come with X price for your product, they're going to cut it by 20, 30%. And say, you prove us this value, then we'll come back to the next review of the contract or the cost, but show us this value. They are not looking to put in a lot of money up front. Not even like the SaaS-based companies. This is just a newer world. And so it's really important that now when companies are pitching, they have these models in mind.
Yes.
And of course, pricing will be important, but you'll balance that with trust in your software provider, product, roadmap, leadership, and then balance it with the usage metrics and the pricing.
That all makes a lot of sense. One thing a lot of our companies do starting out is they're selling to small and medium-sized businesses, and they're giving really big price reductions relative to where they think they can sell the software over the long term. Is that still important with larger enterprises, or is that less of a thing because the budgets tend to be larger?
I think it's a big misconception.
Okay. All right.
Yes, larger companies have larger budgets. How much of that budget is deployable?
Yes.
Most of the budget is already tied up in existing tools that are very difficult to get rid of.
Yes.
And so, because again, a lot of these tools, there's heavy dependence on these tools. To get rid of these tools, you have to invest in another set of product. Those have to be deployed, the users have to be trained. And so there's this whole cycle. So the deployable budget's always limited.
Okay.
And however, now what we are seeing is the more you can show the value of your product, you can incrementally keep going bigger into the budget pile of the company because they'll start to deprecate products.
Yes.
Deprecating products has become much faster now. Most of these companies will have these invest, maintain, and shutdown tiers of tools. And so what they have done is all of the work that happens within the organization for internal employees, they have separated that into various user journeys. And they have mapped all these third-party tools under those user journeys. So these companies have very good visibility on which contracts should absolutely not be renewed, which contracts we will continue to invest in. And so if you are already deployed in the company and they're not having conversation with you, it means you could be on that shutdown.
You're on the number 3 list.
Yeah. And so get in front of them sooner because most of the companies as part of their transformation now are doing this.
This has been a great conversation. I love your insights. Thanks so much for spending some time with us here.
Thank you, Dan.